Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at Twitter, see what people are talking about. Obviously, I'm going to interject my financial opinion along with it. And we're just going to dive right in. It's going to be talking mainly about finances, real estate, commodities, stuff like that. Lots of charts, technical chart patterns, and things of that nature. So if you want to follow me, it's at finding_finance. And if you want to check out the website, it's finding-value.com. Become a platinum member, join our community. Love to have you with us. So let's start with Logan. Yeah, I can't pronounce his last name. This is why using the 2002-2008 economic models doesn't work today. Back in 2007, builders had to deal with 4 million active listings. Today, it's less than 1 million. This is your inventory of active listings. This is a bubble. This is not a bubble. This is ultra low inventory, meaning that sales cannot increase because you cannot sell enough homes because the homes do not exist. This will drive new home builds to record levels eventually. Does that mean that the affordability will get better? Not necessarily. Affordability will probably be pretty bad because as this drives itself lower, the affordability needs to price out more and more people till the inventory levels get back to the mean, which is up here at 2.25 million or something like that. So we're not there yet, and it's going to take some time. And he's responding to Nick Gurley or whatever his last name is. And half of these things that this guy posts, I do not agree with. I mean, they might be okay. The data might be legit. It's just, I don't know why you would use that data and then draw conclusions from that data. That's the only thing I would say. Chart showing the production of largest tight oil shale producers in the U.S. This is interesting, guys. Look at this chart. So this is daily oil production of the top 12 operators in shale. Decline, decline, decline. There are a lot declining of the top 12 going on here. We could see a decline in shale oil relatively quickly. I think that's very interesting, and I'm glad Josh posted that up. Very interesting on the shale front here. Now, here's Michael Gayed. He developed an indicator. He said, did you know that lumber is a key indicator for the stock market, housing, and even credit creation? Let's dive deeper into why it matters and how it can signal high volatility in equities. It says, first, let's understand the connection between lumber, housing, and credit creation. As a primary material for construction, lumber prices directly reflect the state of the housing market. When lumber prices are on the rise, it indicates a healthy housing market and a growing economy. This in turn leads to increased credit creation as banks are more willing to lend when they see a positive market trend. Conversely, if lumber prices drop, it could mean trouble for the housing market, leading to reduced credit creation and a potential slowdown in the economy. Now let's talk about the lumber to gold ratio. This metric compares the performance of lumber against gold to predict market conditions. When the ratio is rising, it suggests a healthy economy, while a falling ratio signals potential stock market volatility ahead. High volatility matters because it's during these times that we often see major corrections, crashes, and bear markets. This is why keeping an eye on the lumber to gold ratio can be a valuable tool in understanding market trends. If lumber prices fall, it's likely that the housing market will take a hit too. This can lead to a domino effect, impacting credit creation and potentially causing instability in the stock market. So how can you use this information to your advantage? By monitoring the lumber to gold ratio and other key indicators, investors can get a better understanding of the market environment and make more informed decisions. And I talk about that. I call this market conditions or market environment. Remember, the stock market can be unpredictable, but by staying informed and understanding the key indicators, you can better navigate the conditions favoring stock market melt-ups and stock market corrections crashes. In conclusion, lumber's performance plays a crucial role in identifying conditions that favor risk-on or risk-off environments on average. Keep an eye on the often overlooked commodity to better understand housing, credit creation, and stock market volatility. Want to learn more about the lumber and other key indicators. One thing that I would say about this is that in 2020, we had a problem where they shut down the lumber mills, and there was a big problem in producing lumber. This ratio and this, the lumber price and a lot of these different, the production of a lot of these different things, the supply and demand is what I'll call it. The supply side got destroyed in 2020, and the demand was very robust. So lumber prices went up dramatically. I think this ratio works very well when you have stable inputs and you slowly, the demand slowly outpaces the supply and lumber goes up. But what if you stop lumber, you stop supply, you stop demand, you stop all these things and then reopen it up? I don't know what the value of those signals are because I think the signals got destroyed for a while and then they have to basically come to a steady state before they start signaling you something. So yeah, lumber prices may have the indicator to build more lumber. They overbuild, and that doesn't necessarily mean that the housing market is going to be slowing down if the price of lumber comes back down from a ludicrous level. So I think that the indicators from a steady state work very well. Indicators from 2020, I think, make it very difficult to read from the next few years on, because those signals were stopped, started, and things got all jacked up. That is one thing I will say about that. It says they created a gigantic wealth bubble by suppressing rates, printing money, bailing out bad investments, and encouraging speculation. The days of free money and low consumer price inflation are finished. Now for rising interest rates, falling valuations, and inflation volatility. Yeah, I agree. We're in a rising interest rate environment. We're going to see falling valuations. We're going to see recessions. We're going to see problems in the market, and we're going to have inflation come in waves, which will be quite volatile with these waves of inflation coming. It says, imagine where oil would be if OPEC hadn't announced the surprise cut. Probably in the 50s, I'd say. On another note, is the second half rally that everyone and their mothers expects not going to materialize? Well, I mean, we could play the what if games, and I don't like playing what if games. It's like, imagine if oil would be if OPEC hadn't announced. Imagine where oil would be if we didn't dump 300 or 400 million barrels of SPR worldwide. Where would oil be? Be in like the 500s. Who knows? I mean, I just don't like playing these games. And I think it's, I don't know, quite frankly, I think it's stupid. I think it's really stupid. You get these inputs, people try to manipulate things left and right. Imagine where oil would be if we left rates at 0% like the Federal Reserve said they were going to be. Imagine if they didn't release the SPR, if they left rates at 0, and the housing market was going unabated to the upside, creating credit at infinitum, and oil was at $1,000 a barrel. Who knows? You know, you can talk everything you want. And I just don't think you can make those assumptions. I just don't like talking the what ifs. You can what if whatever you want. It says if available inventory of existing homes was greater, we'd also have more sales and more mortgage applications. So far in 2023, demand for homes exceeded supply. And for some reason, I don't know why this is, there's a big divide between what I consider to be logical people and then what I consider to be people who just don't grab the logic. This is logical. If the available inventory of existing homes was greater, we'd have more sales and more mortgage applications. But here's the problem. People use mortgage applications and sales as the leading indicators. Wrong. That is wrong. Nick Gurley, wrong. The consulting, whatever it is. This is the right logic. You can't, if we had a bunch of homes, and you could say if interest rates were lower and we had more homes, what do you think sales would do? What do you think mortgage applications would do? They would go through the roof. I know many people who aren't even looking for homes anymore because the prices are too expensive and there isn't enough homes on the market to even find. They just give up. The demand far exceeds the supply so much that the supply is becoming limited to only those that are basically, let's say, in the top 10% of purchasing power people, or the top 10% of savers, whatever that is. You do a bell curve. We're out on the right-hand side of this bell curve of potential buyers because everyone else is getting priced out of the market. Says the commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. Every parameter I can think of is in place for the greatest bull of all time. End of the rainbow type stuff. Maximize income, minimize consumption, and play it the right way. Here is silver's reset before liftoff. This is from Patrick. We've got the early breakout line. We're above that. We've cleared the wall of resistance. This is previous resistance turned support. We're above that. And now we're waiting for this kind of maybe a shallow pullback, something like that, and then the launch. So silver looking really good. Yeah, it might take a little bit of time. No big deal. We've got another one from Grady. He says, this chart shows that when inflation has been persistently high for a while, gold reacts as an inflation hedge, just as it should historically. And an expanding falling wedge is usually a very bullish pattern. Gold versus US CPI monthly, it's breaking to the upside, cup and handle. Now, we've got cup and handles in gold against other asset classes like US CPI. We've got good chart patterns of gold versus Dow Jones Industrial Average. We've got gold versus the money supply breaking to the upside. I don't know what else we can put in front of your guys' face, guys. This is all lining up for a potential big move. And it's across all asset classes. It's gold versus whatever asset class you want to put in front of it that is a non-commodity is going to probably outperform it. Gold against probably even housing too. I know housing's cheap against gold, but we'll see how that performance plays out there. But a lot of these long-term, big-looking, big picture looking charts look absolutely fantastic for anything commodity related. Even oil looks ridiculously good to move higher against the dollar. It looks good even to move higher against gold. It's at a very cheap level, and we'll compress it over time. Could we, in the short term, have gold outperform everything? Yes, we could. I'm talking big picture, big long-term outlooks for the next 10 years. Says, I posted these silver arc-based forecasts years ago with many comments saying they were stupid because a geometric arc cannot predict future price. Those who said that may wish to reconsider and open their minds to new ideas. So silver in GBP, here's your arc going, and it's starting to break to the upside of its final trend line there, breaking to the upside. We've got silver in euros breaking to the upside for silver. We've got silver in AUD. I think that's the Australian dollar. Breaking to the upside, already taken off. And then we've got silver's weight of evidence analysis, and we're ready to break the key breakout line. We're right there trying to break out in the US dollar. So another thing that we can do is we can price all these commodities and other currencies, and they're breaking out in all the other currencies. It's just going to break out last against the USD. That's all really what's going on. And I'm just using silver here to see this. Silver's still holding well above the 12-year blue trend line. Again, this is another one here where we've got the trend line that it's breaking to the upside for silver priced in dollars. It's just breaking out. Could we get a retest back to this blue line? Yes, we could. And then we break on out. Again, the RSI looks like it's ready to break out as well. That's looking pretty good. We've got this ratio shows how undervalued silver really is versus the tech sector NDX. It already broke out on a 14-year chart as posted, so is on the move. Historical asset paradigm shift in the making. These opportunities only come around maybe twice in your lifetime. So this is the silver to NDX ratio. You can see it's a double bottom pattern. You have a lead in, you have a first bottom, and then we're at the bottom of the second bottom. This is going to take some time. It's not going to be quick. This is a big picture chart. And I think we're going to see a massive outperformance of a lot of commodities against tech stocks, S&P 500, and bonds. A rising interest rate environment. It's all interconnected. It doesn't mean it will go straight higher. We're going to get pullbacks. It's going to be nasty and ugly for periods of time. We're going to have recessions. And that's part of the game. And you have to play the game well if you want to make good money in the game. But these charts are showing us that we are very cheap, and we could see a vast outperformance of a bunch of different commodities, especially silver. Here's I like this one. I like this chart, guys. So here's a cup and handle. We came down. We did basically a double bottom. There's the one bottom. Here's the second bottom. And then we broke to the upside of the cup here. And he says, if you are bearish gold here and are bearish here, I just can't help you. When you break these resistance lines, it means something. We just broke gold to the upside. We just broke. It's bullish. And we're starting to see the RSI also break to the upside. So these are all bullish signals in the market that we should be watching and paying attention to. And it's not just, the gold breaking up in the dollar. Go look at it in a bunch of different currencies. It's breaking up against everything. This is just the lagged one. And we've broken out. It's like hitting everybody in the face. Hello, check me out. We've broken out of this big cup and handle. Projected price pattern is the neckline to the bottom here, projected upward, which is a pretty big move. It's looking very good. Here's Rashid. He says, gold setting up for a parabolic move higher over the coming weeks. Over the past 3 years, gold advanced 15 to 24% within 2 to 3 months. If gold breaks a double top, then there's a high likelihood that it advances 25 to 50% with a target range of $2,500 to $3,000 level before the year end of 2023. And we're seeing the market conditions also ripen for this move to move on up dramatically. It's a big break. It's a double top break. And the market conditions of TYX, TNX are moving favorable for gold to do something just like this. Watch a reflation trade. Watch credit creation. If those continue to go higher, gold's going to account for it. So here's Grady. Again, it says, been posting big evidence for 5 months that something big is brewing for precious metals. Gold, silver, platinum broke out big time versus the S&P 500. These are all generational breakouts. Now silver versus Dow Jones Industrial Average is joining in. Ratio charts show which sector will lead. So here's a breakout in the making. This is silver versus Dow Jones. 14-year bullish falling wedge, breaking to the upside. Precious metals outperforming stock market. Big picture means global paradigm shift in the making, with capital flows changing towards precious metals. And you know what, people? I don't know why this is, but they look at everything so short term. Oh, over the past 6 months, it's gone down. Guys, this is big picture view. Big picture. Position here, forget about it for a decade. You'll do incredibly well if you can ride through the volatility and just ride this on up. At least that's my take on it. It's happening again. It's happening once again. Got silver. This is a point and figure chart, a little bit different. This is silver futures, and we're breaking to the upside. It just shows it in a different point and figure chart. So we're breaking final breakouts at 28.80 or so, $29, and then we're off to the what is that? What land is that? A land far away. No, that's Forrest Gump. What's the other one where she clicks her heels? The Wizard of Oz. We're moving to a land way up there. So interest rates and financial conditions have been one of the primary factors affecting the recent moves in U.S. equities, particularly during inflection points. Given these macro correlations, the potential for an increase in 10-year yields from current levels raises fundamental questions about the stability of the financial markets. To be more specific, the debt ceiling issue is setting the stage for one of the largest treasury issuances in history. As the interest from significant buyers of U.S. debt continues to decline and secular inflationary pressures persist, it is natural to wonder how the market will receive this flood of treasuries. Although investors have attributed the rise in 10-year yields in the last 2 years to inflationary factors, the surge in supply was arguably even more impactful. Keep in mind that every financial asset is intricately connected to U.S. treasuries. For instance, The substantial decline in 10-year yields year to date has provided enormous support to long-duration assets, especially mega-cap stocks, which have accounted for nearly the entire gains in the S&P 500 so far this year. My view is that long-term yields will experience upward pressure in the upcoming summer months, which could potentially result in significant implications for financial markets, with a particular impact on corporate bonds, mega-cap stocks, and private equity funds. So what he's talking about is we could see a decline in this based off of the interest rates moving higher because of the surge in supply of treasuries. The surge in supply. And that supply, if it keeps continuing to go up, because they have to issue more bonds, will put an upward pressure on interest rates, which will put a downward pressure on markets. And it's going to help the investments that are not linked to interest rates as tightly. So it's going to help precious metals, oil, and other commodities. And I posted this here. I think I already went over that one. So that's what I've got for today, guys. And home builders are looking strong. Everything's looking strong from that perspective. Inventories are low for real estate. The housing starts are still at average or above. 1.42 million, I think, is where it was at. So things still look good, but we can still have a recession not driven by those sectors. It's other junk getting, we'll say, cleaned out or cleansed out of the system. I still think everything looks incredibly well for commodities, for precious metals, on a big picture view. But that does not mean that it will go up the next month or two. It could, but it doesn't mean that. We're looking at big picture view, big long-term charts that are charting the fundamentals of what people think on a big long-term time frame. And that's where I start my vision, so to speak. And I look at the big picture and say, okay, people think that oil is going to go up, that silver and gold are going to outperform the S&P 500, that oil is going to outperform the S&P 500, that commodities are going to outperform the S&P 500. We've broken the downtrend line and things are shifting. Money is moving differently in this market. It's a paradigm shift that is upon us now. In the short term, being early might look like you are wrong. It'll go up and down. Things will be volatile. We could have a recession and things pull back. You have to get the big picture view right, tie that all together with a strategy, and then look forward 5 to 10 years. That's basically what Warren Buffett would tell you. And how's Warren Buffett positioning? Massively in oil. There's a reason he's doing that, because he's seeing probably the same things that we're all seeing in the commodity space. So that's what I've got for today, guys. Hopefully you enjoyed it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. Love to have you be a part of the community. And we've got a 5 p.m. Mountain Standard Time question and answer session coming up this Sunday. See you there. Catch you later. This is Finding Value.